Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. If these updates are helping you, please hit that like and subscribe button. If not, I hope that you will send them to somebody else who they might help. And don't forget, my clock builder friends out there, I've added a deep dive towards the end of this video that's going to help expand some of your clock building skills. All right, let's go ahead and get to the quick rundown for my friends that just want to know what time it is. We're actually starting this week with a little bit more evidence that the job market's cooling off between ADP, Revelio Labs, jobless claims, and the Challenger layoff report. It all points to a little bit of a softer labor market, and that could possibly set the stage for the Fed to cut rates again on Wednesday. Now, the setup this time is actually better than the cut that we saw in October because the market's already expecting a lot more of a cautious tone from the Fed, which means that the reaction could be more favorable for mortgage rates. Refinances are also becoming a really big part of the story. Right now, there's about 2 to 3 million homeowners that could benefit from a refinance. If rates drop to, say, 5.875 or 6%, that number could jump up to 6 to 8 million pretty much overnight. Now, just make sure that if you're one of those people that's considering a refinance, make sure you're getting good advice from the right place, folks. There's a whole lot of people that are going to try to charge you a bunch of discount points, two, three, $4,000 in additional fees. And because they hide it in your loan amount, they make you feel like you're not really having to pay for it. Paying points is not the right idea right now. Now, if you've got no idea where to start, or you're just scared to death to start on what could be a painful process with the wrong lender, shoot me your loan estimate. Or if you've got a recent loan estimate for a refinance, shoot that over to me, and I'd be glad to give you an honest opinion that's specific to you. Now, there's no cost to do this. I just want to set you on the right path. All right, everybody, inventory tightened again heading into the holidays, which is totally normal for this time of year. And home values are still climbing. They're up about 1% year over year nationally. And here's your quick rate update. The national averages right now are sitting around 5.76 on a 15-year conventional fixed, about 6.27 on a 30-year conventional fixed, 5.89 on a 30-year FHA, and about 5.9 on a 30-year VA. Now, bonds opened slightly weaker this morning, so rates are hovering just a touch higher than they were at the close of business on Friday, but all eyes are on Wednesday's Fed decision, which could be the catalyst for improvement. Now, don't forget, it's not about whether or not the Fed cuts the Fed prime lending rate. It's all about the press conference after and what the Fed chair has to say there. Remember the last Fed rate cut? It was expected, and really the cut didn't do anything like what we thought it was going to. The Fed chair's testimony that came out after the rate cut, that's what sent rates higher, not lower. For 30-year conventional loans, you might start thinking about that refinance when your current rate is about 6.875 or higher. Now, for government loans like FHA, VA, or USDA, it's worth starting that search for the right mortgage team whenever you've got a rate of about 6.6 or higher. Now, even if your personal circumstances and exactly what the agencies are looking for to obtain the best possible rates, we should have time to look at your blood and hair samples and determine what may need to be done to get you in that prime space whenever rates do hit that optimal place. So we're always glad to help. We're always here for you. Just reach out and we'll help out however we can. Now, that's it for my friends who just want to know what time it is. For my friends who like to know how to build the clock, let's dig in. Now, this week's data makes one thing really clear. The job market is weakening in ways that can't be brushed aside anymore. ADP showed a drop of 32,000 private sector jobs in November, but the real story is kind of underneath that number. Small business, which is normally the big engine of job creation, well, they cut 120,000 jobs. Medium and large size employers, they actually added some hires, but not nearly enough to make that difference up. Then Revelio Labs, which actually became really popular during the government shutdown, they kind of strengthened the picture. Their report showed 9,000 job losses just in November, and they also showed losses in 5 of the past 7 months. Now, most major industries are shrinking with one big exception, and that is education and health services, which actually added 26,000 jobs. But that sector grows no matter what the economy is doing. It's just not economically sensitive. When you strip that out, job growth looks very different. Over the last year, that one sector added more than 400,000 jobs, while every other major sector combined actually lost nearly 250,000. So jobless claims and layoffs, they tell the same story. Continuing claims have stayed above 1.9 million since midsummer, which tells us that people are staying unemployed for longer. Challenger reported 71,000 announced layoffs in November. That's sharply higher than last year, and hiring plans are at their weakest levels in more than a decade. Now, all of this is feeding directly into Wednesday's Fed decision. The last time the Fed cut rates in October, the market hated it because Powell told everybody not to expect another cut anytime soon. Now, that turned into a hawkish cut, and mortgage rates actually worsened right afterwards. Now, this time, the setup is different. The market's not expecting a January cut, and it's already bracing for cautious language from the Fed. That means that Powell doesn't really have to say much to create a more than favorable reaction. Even a small shift in tone could give mortgage bonds room to rally. Now, when it comes to rates in the market, I already gave the actual numbers. So if you zoned out, just look back up the screen up here. I'll post them up. Anyway, mortgage bonds are currently trading between the 25-day and the 50-day moving averages, two major support levels. And we tested that support this morning. So far, it's holding. The 10-year Treasury is pushed above the 4.126 Fibonacci level. Remember that term from last week, everybody? And it's now testing the 100-day moving average. So if it breaks above that, we could see a little bit of upward pressure on rates in the very short term. But again, Wednesday has the potential to change everything. For home buyers and homeowners trying to time the market, we're currently floating both under and over that 15-day window. Now, things can change pretty quickly, so make sure that you follow the Shoemaker Loan Team on Facebook or jump into our weekly newsletter to stay updated. Housing continues to follow seasonal patterns. Inventory actually dipped slightly as we started December. Days on market stretched from 61 to 64. And home values, they do remain stable. Again, they're up about 1% year over year, according to both Case-Shiller and ICE. Now let's go ahead and move on to this week's deep dive. For today's topic, I want to shift gears and explain something I use every single day when I'm trying to help my clients decide to lock or float their interest rate. We're talking about Japanese candlesticks, and no, I'm not making this up. If you've ever heard me talk about wicks or bodies or candles on the right side of the chart, this is where all that comes from. Now, candlesticks go all the way back to 18th century Japan. They were actually created by a rice trader named Munisha Homa, who's basically the grandfather of technical analysis. Now, Homa realized something people had completely overlooked at the time. Markets don't just move because of supply and demand. They actually move because of emotion. Fear, greed, and impatience, all the same emotions that drive the markets today. So Homa started tracking rice prices visually, the open, the high, the low, and the close, and those drawings eventually became candlestick charts. Now, a candlestick's pretty simple once you know what you're actually looking at. The thick part, it's actually called the body, that shows the distance between the opening and the closing price for that day. If the close is higher, the candlestick is usually green or white. Now, if the close is lower, it's usually going to be red or black. This, to me, is what makes it look like a Christmas EKG. So the thin lines above and below these candlesticks are called wicks or shadows, and they actually show the high and low points of the trading session. Why does this matter for mortgage rates? Well, because candlesticks tell you who actually won the battle that day, buyers or sellers. A long wick at the top means that buyers pushed prices way up but couldn't hold them. Now, a long wick at the bottom means sellers pushed prices way down, but buyers stepped back in and really strong and reversed it. When you start putting these symbols together day after day, patterns actually form. Some show reversals, some show absolute exhaustion, and some show strong continuation. And here's the cool part. The reason that these patterns actually work is because human behavior has not changed since about the 1700s. Fear and greed look exactly the same today as they did, well, back when rice farmers were creating Japanese candlesticks. That's why candlestick analysis is used in every market: stocks, crypto, commodities, and yes, mortgage-backed securities. Candlesticks don't predict the future with certainty, but they help us understand momentum and pressure and where the market's likely to go next. Now, when we combine that with economic data like the labor numbers, inflation, and the Fed, we get a much clearer read on the direction of mortgage-backed securities and rates. Want to get really crazy? Add in the moving averages and the Fibonacci retracement we spoke about in last week's deep dive. And now you're pretty much looking into the matrix. All right, everybody, that wraps up this week's 1 Minute Monday and our full clock builder breakdown. If you found this helpful, please like and subscribe and share it with somebody who could use a little clarity or some good, honest advice in this crazy market. If you've got any questions about refinancing or buying or selling, or you just want a second opinion or a second set of eyes on that loan estimate that nobody ever showed you how to read, send it to me. There's no cost, no pressure, just honest guidance so you can make the best financial decision for you and your family. Hey, don't forget to follow the Shoemaker Loan Team on Facebook and all the socials for real-time rate updates and ongoing education. You can also jump into my weekly newsletter if you want these insights delivered right to your inbox. Thanks so much for trusting the Shoemaker Loan Team to deliver your housing news and your home loans. I'm Doug Shoemaker. I'll see you next week.